All right, Jeremy, thank you so much for being here on the Retirement Quick Tips podcast. I'm super excited to have you today. And, we were talking about the three biggest mistakes that people make as they plan for their retirement, as they enter retirement. And so I'm so excited to have your perspective on this very important issue. So why don't we just get started? What would you say is the number one mistake that people make as they're planning for their retirement or as they're transitioning into
Yeah,
retirement?
the number one mistake you make when you're planning for retirement is you underestimate the length of your retirement, which is both the starting point and the ending point. There's a lot of research that shows with the starting point, whenever you think you are going to retire, you're likely to retire about 3 years early. So when you're planning your retirement and you think I'm going to retire at this specific age, I'd encourage you to be ready 3 years ahead of time. And then on the opposite end of how long will your retirement last, well, that's your life expectancy. When might you die on average? And on average, you underestimate your length of time by 3 to 5 years. So an easy way is just take whenever you think you're going to start retirement, think when you're going to die, and just add 3 years kind of on to each of it. So subtract 3 and add 3 to both ends. Although in reality, what I encourage you to do is go to a place like longevityillustrator.org and get a personalized longevity estimate. It's based on your health, your gender, smoking status, and it'll give you a great actual scientific estimate for how long might you be living in retirement.
Yeah, well, it's so interesting because when you add up the 3 to 5 years at the beginning and then the 3 to 5 years at the end, you could live for maybe 10, you could live in retirement for 10 years longer than you actually think that you will, which is, that's not good for planning. Like if you only plan for a 20-year retirement and it's actually more like a 30-year retirement, that's not good. And I read a Wall Street Journal article about this just the other day where people's perception, they think that they're going to retire at 65, but the actual typical age that someone retires across the United States is more like 62. So that 3 years, even on the front end, there's a lot of planning that goes into that. Is like, okay, well, if I retire at 62 instead of 65, what adjustments do I need to make? And I think that's kind of what you're talking about
Yeah,
there.
that's exactly it. You're probably planning on 65 to 85. In reality, it's more like 62 to 92. And so 30-year retirement's more likely what you need to plan for, not just a 20-year retirement.
Right. So what kinds of things should people think about if they're going to retire earlier than they planned? What should they be
Yeah, the
doing?
one part of it is just whatever you have in your spreadsheet as your age, just subtract 3 years. You think you're retiring at 60, make it 57. That'll just help out in your planning. But then in reality, when you've got your investments set up to not retire for 3 more years, you probably have more risk than perhaps you ought to have. So it's not just about make your spreadsheet be ready for retirement, make your investments ready for your retirement 3 years ahead of time. If you were retiring next week instead of 3 years from now, you would probably change your investments. You would probably have more interest rates, more short term, more stability than if you didn't think you were going to retire for 3 more years. So you probably want to get your retirements ready 3 years ahead of time, which means bringing down the risk.
Yeah, that's a really good point. Because I'll have clients who have surprise retirements. I had a lot of that in COVID. I had a lot of that. I've had a few clients who, in recent years, who have been laid off later in their career. And so they're plunged into this unexpected early retirement. And usually, what we end up doing is kind of reworking their investment portfolio. But you would want to do that gradually rather than all of a sudden. So it creates some extra challenges. You're right, when your portfolio isn't set up for that plan to retire maybe a little bit
That's
earlier.
exactly it.
Yeah. Okay, so what's the next mistake that people tend to make?
The next mistake that you make in retirement is you file for Social Security at the wrong time. So don't file for Social Security at the wrong time. And one reason why you're filing for Social Security at the wrong time is you might be basing your thoughts and kind of guidance from others, like your parents, Well, your parents had different rules for Social Security. They might not have had that ability to do the delayed retirement credits. They might have had age 65 for the full retirement age as opposed to age 67, like a lot of people retiring today. And so, one, you should go get your personalized longevity estimate, but then also go get make your Social Security decision personalized. Don't just file at 62 because your parents filed at 62. Don't just delay all the way to 70 just because virtually every financial article says delay till 70. Look at your Social Security, and especially if there's two of you, you have two different decisions on it. And a lot of times people think whatever I did for one, I'm going to do for the other one. If I took it early, I'm going to take the other one early. If I take it later, I'm going to take the other one later. I'd encourage you almost maybe to do the opposite. If one you went early, maybe go later on the other one. And the way to go about thinking it this way is, especially if there's two of you and there's two different Social Securities, that means that there's a bigger one and a smaller one. And the bigger one will last for longer. The smaller one just goes away sooner. No matter who dies first, the smaller one goes away. So think of it like your Social Security box, where you've got a smaller amount that doesn't last as long, or a bigger amount that lasts longer. So you've got a bigger box for that bigger Social Security amount, and do what you can to get that one as big as you can, because that will last longer. So if you are the person who has the higher Social Security benefit, especially if you're older, you probably want to wait as long as you can, because this is going to be growing at it's going to grow at a bigger dollar amount. If they both grow at 8% per year, which is what it does, the bigger number, 8% on a bigger number, is a bigger number. So that's the one you want to focus on and grow. And then the smaller one isn't nearly as important. So if you've got a thought, I kind of want to take my Social Security early, maybe do that with the smaller benefit. And if you're trying to get the most out of Social Security, and especially to protect the widow, take that higher Social Security and wait as long as you can.
Yeah. Yeah, I think it's really helpful. A lot of people, when they go logging into the SSA.gov and getting that full statement that shows, here's what it's going to be at 62, 63 every year, all the way out to 70, you can really see that there's a huge disparity for the higher income earner between if you took it as early as possible at 62 versus waiting until 70. Whereas, in a lot of couples, there's a big difference between one spouse's Social Security and the other. So for the lower income earner, you might only be giving up a couple $100 a month or something like that by taking it early. But for the higher income earner, I mean, you could be talking about $1,000 or more in difference of income. And you're right, what you said about the widow, preserving that higher benefit. I think a lot of people just think about, well, what am I going to get paid today? I need income today. I would like to start my Social Security today. But then we're talking about the longevity and how long you're going to live, but also the likelihood that, one spouse could outlive another by many, many years. And that other spouse is also going to need that higher income stream. So it's so important, I think, to really preserve that higher benefit amount for married couples and delay that if you can, because your surviving spouse, if they outlive you, is going to receive that higher dollar amount.
Yeah, and if you're trying to figure out how to get the most out of Social Security, you've got to approach it with the right attitude. And usually the attitude is, how do I get the most money next month? Really, you should be thinking about, how do I get the most money over my entire lifetime? And especially thinking, if there's two of you, how do either of us get the most money over a lifetime? And really think about that widow. A lot of 92-year-old widows, ladies especially, are living on the decision made 30 years earlier by their now deceased 62-year-old husband. And chances are, especially 30 years ago, he probably wasn't thinking about you. He wasn't thinking about his 92-year-old widow. Unfortunately, that's just kind of what happened. So as you're making your Social Security decision today, think about your future self, and even more importantly, if you're the higher benefit earner, and if you're the male especially, think about that widow 30 years from now, and every decision that you make now is going to be affecting her 30 years from now.
Yeah, that's a really good point. Okay, so Two big mistakes. We talked about the longevity issue and well, retiring earlier than you planned, and also living longer than you planned, and then Social Security. So what's the third biggest mistake that you see people make with their
Yeah, third biggest
retirement?
mistake you make with retirement is you forget to plan for the retirement taxes. So when people come into my office and they're planning for retirement, they've got their spreadsheet of all their expenses, and they figure out, okay, I just need 5,000 a month or whatever that number is to live on in retirement. Well, that's maybe another topic for another day, but chances are your spreadsheet's wrong. When you're starting from ground zero and building up your budget, you just ignore all reality and you think this is the perfect world. I'll never go out to eat. My cable bill will never change, things like that. But even if you got your spreadsheet correct, this is the amount you need for retirement, you almost always forget healthcare and taxes, which makes sense because your paycheck that you're living off of already took out your health costs and your taxes. And your taxes especially, I like to, when you plan it out, have a specific line item. Okay, I need $5,000 a month for living, but what's your specific line item for taxes? And when you have that specific line item for taxes, it helps you recognize that this is variable and you can make decisions on it. You could pay taxes early to save taxes later on. Most people, when they realize that, oh yeah, I forgot to plan for taxes, what do I need to put? Like just 20% on there? Like this static number, like you retire and the government sends you a card saying you pay 20% taxes for the rest of your lifetime. That's not the case. Your taxes fluctuate wildly up and down throughout time based on whether you're retired or not, whether you are married or single, you file for Social Security, are you on required minimum distributions, the tax laws are changing in 2026. There's a lot of things that change with your taxes, and you've got the most ability to control your taxes in retirement than you've ever had before, because you can choose which accounts you take money from. You can choose when you take money out. If you take money in December or January, right, that could be a week's difference, but it's 2 different tax years. Or you've got traditional accounts, Roth accounts, regular brokerage accounts, and savings accounts. Those are 4 different accounts with 4 different tax situations. So you've got all this ability to control your taxes, and when you take that control, I often see you can cut your lifetime tax bill by 20% or more, often $100,000 or more in lifetime tax savings because you took control and you chose to pay taxes when you see that you're likely to have a low tax rate so that you can avoid the taxes later on when you're likely to have a higher tax rate. So not just throw a 20% number into your spreadsheet to say that's how much I need to plan for taxes, but proactively say, I'm going to do things today to save on taxes in the future.
Mm-hmm. So you're talking about withdrawals and the timing of that and which accounts to withdraw from. And so what kind of specific advice or guidance would you give somebody who has all these different types of accounts and, you know, maybe not quite to that required minimum distribution age from their IRA or 401k? Because I know that the standard advice is, well, just take everything out from your taxable accounts first, and then when you get to your RMD, required minimum distribution age, then you can start taking the IRA withdrawals, and so but then you have to deal with the capital gains taxes. So how do you, there's just so much to unpack there, and I think it's tricky because there's not really this like blanket advice that works for everybody. So how would you recommend people approach that withdrawal taxes and trying to keep their taxes to a minimum?
Yeah, so the blanket advice is look for the times when your taxes are likely to be lower and pay taxes in, and look for the times when your taxes are likely to be higher and avoid the taxes in. And your taxes are likely to be lower when the stock market's lower, before 2026 when the taxes are expected to grow, before you turn on Social Security, before your required minimum distributions start, before one of you dies and you go from married filing joint to now the single taxpayer. So that's just kind of a generalization. When you're looking at these things, you might add up and say, oh, the market's at a high point, but it's before 2026 and I haven't filed for Social Security, I'm not on RMD, and I'm married. Right, you've got like four yeses for the low taxes and one yes for the high tax situation. You know, it's stacked. The DAC is stacked towards maybe pay taxes now if that's your situation. So that's kind of a generalization. But even better is to just project out and plan it. So when we do tax planning for retirement, if we think you're going to have a 30-year retirement, we'll have 30 years worth of tax returns projected out based on here's what you're likely to do. And then thankfully there's computers around, so it can run tens of thousands of scenarios that say, well, what if you spend money from your regular account, or you spend money from your traditional, or you spend money from your Roth? Or what if you take your traditional and move it on over to Roth? And if you do a Roth conversion, well, how much do you do? And if you do that, well, how long do you do it? Do you stop after 1 or 2 or 3 years? Do you stop after you turn on Social Security or you hit the required minimum distribution age? And so generally thinking, just look for the times when you have lower taxes and try to pay the taxes then to avoid the higher taxes later on. Better yet is to do it on your own or work with a retirement-focused financial planner that will project out your entire retirement tax returns and then change things around to see, well, can we lower those taxes over the lifetime? Generally speaking, yes, Roth conversions are a good way to go. And yes, the general situation or general recommendation, they call it conventional wisdom, is to spend down from your taxable accounts first, which is your regular brokerage accounts. But the improvement upon that is if you spend down from your taxable accounts now, you'll probably have a fairly low tax situation. Use that tax room to take money from traditional, move it on over to the Roth. That's the general way to look at it.
Yeah, I agree. I think, early retirement taxes tend to be lower for a lot of people, and that would be the time. You have this short window of time before maybe you start Social Security, before those required distributions kick in. But do you find that, on paper, it's like, yes, this makes sense. But when push comes to shove, I think a lot of people have a lot of reservations about doing the Roth conversions because they don't want to pay all those taxes up front. So they you kind of walk them to the pool, but then when it's time to jump in, they're like, I don't know, or they do a lesser amount than what would be advisable. Do you have those issues, or I guess, how do you overcome some of the real, I think, objections, which is, I don't want to pay Uncle Sam all these taxes right now. I would rather just not do that and kick the can down the road. How do you address that concern?
Yeah, that's why you have a kind of a before and after, right? So you've got, here's if you don't do anything, here's if you do, and over your lifetime, it's $800,000 of taxes projected over your lifetime if you don't do any Roth conversions, and then $600,000 projected over your lifetime if you do the Roth conversions. When you see the numbers stacked up, where you see six-figure numbers, 100 grand, 200 grand plus of lifetime tax savings, that gets you thinking, okay, I'm willing to pay the taxes earlier. And it is a sacrifice. It will cost you money today to pay taxes today, and the intent is that it saves you money down the road. That's exactly how you got to a good retirement. You were 20, 30, 40, and you were saving for retirement so that you'd have the retirement dollars later on. You hit retirement, and your sacrifice, your pre-planning is not save money today, it's pay taxes today so that you can have a tax-free later on in retirement.
Yeah, I agree. And I've seen the numbers like you have, where you expand that over 20, 30-year retirement, and being careful and thoughtful about the taxes especially really has a huge impact. It's hundreds of thousands of dollars difference that you wouldn't otherwise have later on in life in your investments if you weren't thinking about the taxes. So I think a lot of people, especially people who don't run the numbers on their retirement, don't realize how big they seem like little decisions, but because we're talking over a 30-year time period, Roth conversions, when you take Social Security, I mean, all these decisions on their own can mean the hundreds of thousands of dollars difference in assets fast forward 20, 30 years. So yeah, I think that's really important. Okay, so we've touched on a few of the resources, the longevity calculator. Can you maybe talk about some resources that are available and kind of hit on those again, that are available for people to look at their longevity, look at their Social Security and what might make sense, and think about the taxes a little bit?
Yeah, so the the easiest thing you can do personally to estimate the length of your retirement is go to longevityillustrator.org. So that's a way to get a personalized estimate of how long you might be living in retirement. I'd encourage you just by seeing all the studies over time. It's over 10 years that they've been doing these studies that see that on average you're retiring 3 years ahead of time. Just take that, and whenever you're going to retire, you're planning on retirement, just get ready 3 years ahead of time. And then when you're trying to get the most out of your Social Security, actually your longevity illustrator, your longevity estimate is going to help you out. Because a lot of times people say, well, what are the odds I'll actually make it to my break-even age? Well, here you go. Here's the literal odds of how long it'll take you to make it to the break-even age. And quite often those odds are much higher than you would expect. So that longevity illustrator, that better estimate of how long you might live in retirement is going to help you make a better Social Security decision. Although you ought to go to socialsecurity.gov, log in, get your own personalized Social Security estimate. Because all Social Security does is they take last year's earnings and they believe you're going to earn that all the way to age 70, and that's where they give you the numbers. And you hopefully know more about your own retirement plans than the government, where you know exactly what you earned last year, and maybe it's not going to be that exact amount throughout time. Maybe you're not going to work all the way till 67 or 70. So you can plug in and get your own personalized estimates. And if you get the numbers correct to begin with, you're going to be already far ahead. And when you're planning for the retirement taxes, I'm going to say that's tough to do on your own. Make sure you work with a retirement-focused financial advisor that's projecting out your full 30 years or whatever it is of taxes over time, and is keeping an eye on the specific years when you might be better off filing or paying your taxes by doing Roth conversions. Although just think in general, if you're a do-it-yourself investor, think in general, when are my taxes likely to be lower, and pay your taxes then so that you can help avoid those taxes later on. I've got a guidebook put together, so you can go to avoidbigretirementmistakes.com, and it tells you even more.